Inflation versus home ownership. Which one performs better? And how do today's foreclosure numbers compare to the time right before the housing bubble burst? That's what we're going to cover in this monthly market report. This is for you if you're a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client, or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and here is the market data that you need to make an informed buying or selling decision, or help your client do the same. Let's begin with a quote from Investopedia, which says, "Real estate is one of those time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values." So what we can see here is that homeownership is one of those things that you can lock in the cost of today. It's an asset that's increasing in value over time, and as prices rise and home values rise and all other prices around us rise, locking in that fixed cost in homeownership is really game-changing as a hedge against inflation tomorrow. So here is a visual representation that depicts what we're talking about as it pertains to homeownership outperforming inflation over time. This is home price appreciation versus consumer price increases over the past decades. And it goes all the way back to the 1970s. Now, what you're looking at here is the blue bars, which are the average inflation rate for the decade, and the green bars are the average home price appreciation rates for each of those decades as well. Let's look at the 1970s to start, where home ownership outperformed inflation. Then in the 1980s, it was a little bit more balanced, and that most likely had something to do with the savings and loan crisis. And as we look at the 90s, we start to see home values tick up again a little more, outperforming inflation throughout that decade. Then in the 2000s, of course, we had a housing crash, but look at the 2010s and beyond and just how dramatically housing prices outperformed inflation. So over time, what you can see is that homeownership is generally looked at as this great hedge against inflation because home values are performing better than the inflation rate. That means that someone buying a home today can lock in today's cost and protect themselves against the rising cost of inflation in their biggest monthly payment going forward. Now, this becomes really important when we start to talk about renting, because renting takes on the risk of rising rental prices year after year. Here is a quote from Bankrate. "A fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment. Sure, property taxes will rise and other expenses may creep up, but your monthly housing payment remains the same. That's certainly not the case if you're renting, and that's because rental prices rise year after year, and so this becomes really powerful for someone who might be sitting on the sidelines thinking, I could buy today, but I'm going to kind of press pause and I'm going to wait. I'm going to wait and see what happens for home values, if they drop, if they rise. Well, all the forecasts that we've seen show that home values are projected to continue rising. We also know that mortgage rates are projected to keep rising, and we know that rental prices are rising. So that means that someone who continues to rent but could buy is taking on the additional increases in rent year after year. Plus, it's going to cost more to buy a home down the road. So it's really important for renters to understand this dynamic. We've talked a lot about home price appreciation and where that is headed. So let's take a look at this next graph from the Home Price Expectation Survey. And I think this gives you a clear picture of where home prices are projected to head according to the experts. The Home Price Expectation Survey is a survey of 100 economists, data analysts, people who are projecting home price appreciation. And in the fourth quarter of last year, this was a projection for cumulative house appreciation by 2026. They divided the group into optimists and pessimists, optimists being the ones projecting the most appreciation over the next 5 years, and pessimists estimating on the lower side. So take a look at that orange bar. Those are the pessimists, the experts that are saying home price appreciation will be on the lower side cumulatively by 2026 over 23%. So as experts look forward, home values are expected to increase over time, even on the lower end, 23%, which is pretty significant over the next 5 years, not to mention that if the optimists are just partially correct, the appreciation will be even higher. Let's talk about mortgage rates. Considering what rates have done over the last couple of months, there is just no way I could have left them unmentioned in this monthly market report. We've certainly seen a rise in mortgage rates in a volatile environment. So if we look at this rise in rates, we're about at 3.55% as of the beginning of February. This graphic goes back to the beginning of 2020, and we're starting to get back into that area where we started when the pandemic came upon us in March of 2020. It's worth mentioning that this data does not include the events of the last 2 weeks in which we saw rates rise substantially more. So unfortunately, that 3.55% you see on the screen now is outdated. So what could this mean for the housing market as a whole? Well, here's a quote from Freddie Mac to answer that question. As mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. I would agree with that, and I would go further to say that the statement should not just be confined to entry-level buyers, but the market as a whole. The fundamental need for real estate that people have in this market overshadows any rise in interest rates that we have seen thus far. The quote goes on to say, in 2022, we expect purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 22, while refinance activity is anticipated to decrease from 2.7 trillion in 21 to 1.2 trillion in 22. Why is this important? Well, look at the two mortgage markets. You have the purchase market and you have the refinance market. The purchase market is forecasted to grow. The refinance market is forecasted to constrict. And that makes sense in a rising interest rate environment. However, clients are going to see headlines that talk about the overall mortgage market constricting and that housing is going to melt down like 2008. We need to be the educators with regards to this topic. The purchase market is going to grow, the refinance market is going to constrict. That's all there is to that. So if you take this rate of 3.55%, which in fact is now over 4% as I speak, that's still a very, very favorable rate when you go back all the way to the 70s. This is the average 30-year fix by decade. And what you see there are very, very favorable financing conditions when you look at matters historically. Let's talk about forbearance. I think today's data is really going to help articulate why we will not see a wave of foreclosures coming to the market. Now, here is an update on how many loans are in the forbearance program. Loans in forbearance have now fallen below 1 million. This is massive. We're at roughly 780,000 loans in forbearance today, and that equates to about only 1.4% of all mortgages. If you think about where we started over in the red bars on the left, there were nearly 5 million homes in forbearance in May of 2020, and we're down to just about 780,000. So huge progress, and just one more data point that supports this is vastly different than what we saw in 2008. Let's take a look at what the foreclosure situation looks like in a typical year in the US. And as you look at this slide, keep in mind that 9.3 million homes went into foreclosure when the housing bubble burst. We're in a really, really different situation now. What this says is that over 422,000 fewer foreclosures took place over the last 2 years. Look at those first three red bars. The taller ones on the left, that's 17, 18, and 19. The number of foreclosures we had in those normal years leading up to the pandemic averaged just under 300,000. And so the unfortunate reality is that in this country, every year there are going to be homeowners that go into the foreclosure process. Now, if you look at 2020 and 21, these were not normal years. This is where the forbearance program came into play, and there were far fewer foreclosures in each of those years. So if you look at 2020, there were about 120,000 foreclosures. That was short 161,000 of what would have been normal. 2021 through the third quarter is what we have data for right now, and that was only 29,000 foreclosures, so massively short. That's where that 422,000 number comes from, and contextually, if you think about that, that is incredibly low. In fact, it's so low, I think this next graph really shows it well. Foreclosure activity is actually at an all-time low. Look at the number over on the right side of the screen, 2021, where there are only 151,000 foreclosure filings. If you put this into context and you look at those red bars, 2007 through 15, millions of homeowners were going into the foreclosure process. And that is vastly different from where we are today. I mean, even if this number of 151,000 doubles, triples, or even quadruples, we are nowhere near where we were when the housing bubble burst. And this is massively impactful, showing that the fundamentals of today's market are just very, very different. So that's a wrap for the February monthly market report. I appreciate you listening in. Forward, subscribe, share. I'll be back next month. But before you go, if you're looking into a purchase or a refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for watching. Bye for now.